Hey everyone and welcome. Today we are tackling a huge debate for pretty much every modern Indian investor: the wild, fast world of crypto versus the slow and steady path of equity. Is one a get-rich-quick ticket and the other just, old news? Or is there a massive trap hiding in plain sight? Let's get into it.
This one question right here, it really cuts right to the chase. It perfectly sets up the battle we're looking at today. You've got the incredible pull of crypto versus the stone-cold math of compounding. Are we all just chasing those quick, flashy gains and accidentally sacrificing our long-term wealth? So, first things first, let's be real about the pull of crypto. It's powerful. For so many young Indian investors, especially Gen Z, it feels like this once-in-a-lifetime shot to just skip the traditional career ladder and find financial freedom like right now. And this is way more than just a trend. It's a whole financial movement. You're seeing these stories everywhere on social media about people becoming overnight millionaires, getting 100x returns. And the dream is so simple, so powerful. Get rich fast. But you gotta ask yourself, how often does that dream actually line up with reality?
And that leads us straight to the flip side of the coin. We have to talk about the brutal truth of volatility. Because it looks like crypto's most exciting feature, those massive, insane price swings, might just be the very thing that makes building real, lasting wealth with it almost impossible.
Okay, check out the contrast here. It is just stark. On one side, you've got Bitcoin's journey from 2021 to 2022, a mind-blowing 150% spike up, followed by a gut-wrenching 70% crash. Then, on the other side, you have equities just chugging along with a reliable 12% compound annual growth rate. One's a roller coaster, and the other is a staircase.
Now, to really get why this matters so much, we need to talk about the magic of compounding. Seriously, some people call it the eighth wonder of the world, and it is how true wealth is built over time. But it has one single, non-negotiable rule. You have to have a principal amount to start with. Your money needs a solid base to grow from.
And here's the trap right here. That 70% drop we just saw, that's not just some numbers on a screen. It's a catastrophic blow to your compounding engine. It completely wipes out the foundation your future wealth was supposed to be built on. Plain and simple, your money can't compound if it isn't there anymore.
But wait, it's not just the wild market swings that Indian investors have to worry about. Oh no. There are a bunch of other hidden costs and serious hurdles that make playing in the crypto world especially tricky over here.
Let's just break it down. First, the tax rules for crypto are, well, they're tough. You don't get the benefit of indexation, which helps you account for inflation with other assets. Then you have SEBI, the Securities and Exchange Board of India, constantly warning people about the huge number of scams out there. And finally, there's the classic human mistake. Most everyday investors buy high when everyone's excited and then panic sell when the market drops. And let's put a hard number on that tax problem. We're talking a flat 30% tax on all crypto gains. No offsetting your losses against other income. Oh, and there's a 1% tax deducted at the source on your transactions. This tax setup by itself can just chew up a huge chunk of any profits you might manage to make.
So if crypto is the crazy high-risk gamble, what's the alternative? Well, it's the thing that often gets overlooked, the one people might even call boring. It's the machine that has been reliably building wealth for generations: equities.
And here's the key difference. It's all about what you're actually investing in. With equities, you own a tiny piece of a real company, a business that makes money, that grows, that creates actual value in the world. Its growth is tied to real things. Crypto's value? Well, it's mostly driven by hype and speculation, which makes it way less predictable and, as we've seen, way more volatile.
Now look, this doesn't mean you have to avoid crypto like the plague. It's not an all-or-nothing game. The real key is to come up with a smart, balanced plan that lets you maybe take a shot on something speculative without betting your entire financial future on it.
So here's the smart approach, broken down into two parts. Step one, and this is the most important part, you build your core. This is your foundation for compounding, built with solid stuff like equities and mutual funds. Then, and only after that foundation is secure, you can carve out a tiny little speculative sleeve for your high-risk, high-reward bets like crypto.
And this chart shows you exactly what that looks like. It's simple. The vast, vast majority of your portfolio, we're talking like 95%, is in that core compounding engine. Then, a tiny little slice, 5% at the absolute most, can be set aside for speculation. That way, if your crypto bet goes to zero, it stings, yeah, but it's just a small loss. It doesn't sink your whole ship.
So, as we start to wrap this up, the most important takeaway is to step back from all the noise and all the hype and just ask yourself some really tough, honest questions about your own financial life and what you're actually trying to build.
Okay, first question, and be brutally honest with yourself here. If your crypto investment crashed by 80% tomorrow, which, let's be clear, is totally possible, would your big life goals, like buying a home or retiring someday, be completely derailed? If the answer is yes, you are probably way too exposed.
Second, think about the trade-off. You've got this reliable compounding base you're building in equities. Is the lottery ticket potential of a huge crypto win really worth risking that solid foundation you've worked so hard for?
And that brings us to the last and maybe the most important question of all. Forget about the next 20 days. Forget the next 20 weeks. How does this investment fit into your 20-year plan? Because at the end of the day, real wealth isn't about one lucky bet. It's about decades of discipline and compounding. It's a marathon, not a sprint. Something to think about.